Guys, this video will be something special. I can see it coming. I'm gonna explain to you guys how you can predict moves like these, how you can predict a potential breakout right now, how you can predict a reversal here, another one here, and even all the way up here. How you can profit from moves down, moves up, moves down, and moves up pre 9:30, pre-market open, using crude oil, the crude oil futures contract. And I'm going to show you guys how you can do all of that as well after 9:30 using the NASDAQ future. All right, guys, this will be a video that can change a whole lot for you, at least in my opinion, because you will understand why the market moves the way it does. You will understand the logic behind it, because once you understand the logic behind it, these moves here, all of these moves become obvious. And if a move becomes obvious and you know what happens next, if you know that the market will most likely turn around here, because this will be so obvious to you guys that you cannot unsee it anymore, then trading, getting into a trade here, short, and trading it all the way down here, because you also know that the market will most likely turn around here. Guys, trading will become effortless for you guys. So this video is brutal. If you've ever been confused about trading, you didn't understand why you're getting stopped out at a certain level and why other trades seem to work out effortlessly, you don't know why, this video will explain everything to you. Like I said, we're gonna go through some examples with the entire logic using NASDAQ after 9:30. So if your workday starts at 9:30, the NASDAQ might not be the right instrument for you to trade with, but then you can obviously trade the crude oil futures contract. But if you also have some time after 9:30, because your workday allows you to be on your computer, or you just have some free time during that period from 9:30 to about 4, well, then you can trade the NASDAQ. So no matter what time you are available, no matter what time you have, as long as you have about 30 to 60 minutes pre-market open or after market open, and nearly anyone has that, you can make this work. So let's get right into it. We're going to start with crude oil, okay? And we're going to start with today. Now, obviously, I have the benefit of hindsight right now, okay? But test me on all of this. Test me on everything that I'm going to tell you right now. Literally everything. And you will see that this is actually true. It's not difficult. Okay, guys, so let's get into it. So the market opened up obviously at 12 a.m. Well, today started at 12 a.m. So we're going to take all of this starting here at 12. Okay, this is what we're going to focus on for now. And we can predict certain moves already. So let's get right into it. So this right here is about 1:15 a.m. New York time. So if you're a night owl, you can even trade this during the night. And we now want to see a few things to get active. Now, in order to get active, meaning, hey, I want to trade at these levels, you need what? You need levels. You need price levels where you know things might happen there. And these levels are very obvious to see, very obvious. And all you need is the understanding of how the market works. And the first thing that you need to know is liquidity, okay? Liquidity is explained to you. If I explain it to you, you will understand it right away. Let's say the market is balanced, okay? The market is just trading back and forth, back and forth. Here you have the lows, and here you have the highs. Some people call this support and resistance, okay? That's what people usually call it, support and resistance. Now, if you are a retail trader, and most retail traders lose money, what do? Well, they're gonna get in here, hoping the market will break out potentially. Maybe they get in here, it doesn't really matter, because now they believe, hey, we have clear support, so the market won't go below. I know this, they say to themselves. I know this, okay? So they buy down here, and where do they put their stop loss? meaning a sell order, because they just bought. So in order to get out of their position, either for a profit or for a loss, it needs to be a sell order. Well, most likely somewhere in this range right here. This is where they're gonna put their sell stop order, okay? So we have a lot of sell limits right here, which is liquidity for the market, okay? Lots of orders here, lots of orders, passive orders, okay? There's passive and aggressive orders, and these are passive limit orders, okay? But you also have the same on the other side. You have a bunch of buy. This is going to be a beautiful B, a bunch of buy limits right here, because people see this range and they go in here short. They go short, and in order to get out of their position, they need to buy what they sold previously. So all of their buy stops are somewhere above this level right here, okay? So we have a bunch of liquidity here, but also here, okay? Now you need to understand, the market wants to transact as many contracts as possible, and the market can only do that at a couple of locations. It can only do that at levels of liquidity and levels of previous market acceptance. So let's go through liquidity first, and then I will show you where there was previous market acceptance. Okay, guys? Liquidity. Look at this chart right now. Where do you believe is the most liquidity right now? Where? Look at this. Just check it out. It's very obvious. Most liquidity will be, and I'll help you guys. Most liquidity will be somewhere most likely here. Why? Because retail traders, the exact same situation I just explained to you guys, will place their stop orders above these highs here. But we will also have some liquidity, obviously guys, below this low. That's very obvious, right? Very obvious. Okay, good. Interesting. But we also said that the market likes to trade at levels and react at levels of previous market acceptance. Now, what is that? If we look at the volume profile shows us where the market liked to transact. So we have these high volume nodes, and I'm going to draw this out for you guys. We have these high volume nodes here, here, and here. We have these low volume nodes, meaning the market liked to transact at these prices, because basically what these high volume nodes indicate is, hey, the previous day, the market liked to transact at these price levels. So we had a lot of contracts being traded at the 64.34. We had the most contracts traded at this price level right here. So at this price level, we have potentially thousands of contracts traded just at the 63.65. But maybe here at the 64.19, we only had a few hundred contracts that were traded. So we have low volume areas, high volume areas, and the volume point of control. Now, the market likes to transact either at levels of liquidity or previous market acceptance. And the combination of those two is even more powerful. You see this right here? Level of liquidity and previous market acceptance. Beautiful, guys. Okay, we'll combine all of this together. So now, you're in the middle of the night. This is already, you're now in front of your laptop and you want to get active. You want to potentially find a nice solid trade. What can you now think? Well, you now want to see, what does the market do at this level or at that level? And you're going to see this. Let's fast forward a little bit. And something very interesting just happened right here that I want to explain to you guys. This right here is a candle that will become very important. So this candle right here looks different to all the other candles, right? Why is that? Well, if we look at how this candle is formed, we have the candlestick, the body, and we have the wick here. What is so different? Well, usually all these candles look somehow like this. We have the body and we have small wicks on top or at the bottom, just like all of these. Look at all of these candles. They all look the same, right? All of them look the same. However, this candle here looks kind of like a hammer stick. Okay, what does this tell us? Well, candles, if you look at it in terms of volume, are being formed either equally or non-equally. Meaning, if we say that we have 100 contracts, just to give you an example, just to make it super easy. Let's say we have 100 contracts that are being traded in every single candle. In candles like these, you might have 20 contracts here, 20 contracts here, 20 here, 20 here, and 20 there. So it's equally distributed. However, in candles like these, you might have 80, this is an 8, 80 contracts being traded here, and the 20 other contracts, they were traded 5 here, 5 here, 5 here, and 5 here. So this is not equally distributed. And what this usually tells us, and also the time, meaning this is also very for you guys to understand. If this is a 5-minute candle, the market did not trade a long time at this level, at these levels right here. Where it was just a back and forth the whole time. So this candle, if you look at it live, was probably, it started off here and then boop, boop, it went up and down and continued trading somewhere here. Now, what does this indicate? It indicates that we had some stop fishing going on. Stop fishing is basically we have a bunch of liquidity and the market just grabbed that liquidity and then went on to do its thing. Now, that's what these candles indicate. Usually it's stops that are being fished. You want to combine this information now, stop fishing, with another advantage that you have in the market. And the other advantage that you have in the market now is, where is previous liquidity? Where is it? And I'm going to show you guys where it is once more, because I just deleted that. We have some liquidity here, right? Okay. So we wait until the market goes to either this level here or this level. And then we see, what is the market doing at those levels? Aha, interesting. What do we see again? We see once more these huge candlesticks. And abnormally in the market once more. This candle doesn't look normal. Neither does this. So once you see these two candles right here, these 5-minute candles, that's already an indication of, hey, the market most likely fished those stops. And I will tell you exactly why the market does that in just a second. Okay, but for now, the market fished those stops. And what is happening right now? The market likes to transact from liquidity to liquidity. So, to give you an example, there was most likely a big market participant who went in here short of, let's say, just to give you guys an example, 1,000 contracts. Now, that's not what happened. It's most likely going to be a lot less. Doesn't really matter though. The NASDAQ, once the market is open, that could actually be a real number. However, let's just go with this number for now to explain you guys what's most likely going to happen here. The market participant, some big bank, maybe a hedge fund, an institution, went short here for 1,000 contracts. Okay, short 1,000 contracts, meaning they sold 1,000 contracts. Where can they most likely get now rid of those 1,000 contracts, meaning they need to buy it back for a nice profit? Where? Well, let's take a look. Interesting. I would say, since we know that the market likes to transact at levels of previous acceptance, we can potentially get rid of those 1,000 contracts as a big market participant somewhere here at this level. So they might even be out of their position already, or even intraday at levels of intraday acceptance. So somewhere down here already. So the market participant might already be out with a pretty nice profit, or he might still be in and wait for the market to do what? Well, to fish some more liquidity, because where else is liquidity, guys? Intraday. Just look at it from today's perspective. We have the previous lows right here. So we know, hey, there is some liquidity, and I explained this to you guys already, some liquidity down here. But intraday, just looking at today, where else is some liquidity? Most likely. It's very obvious, guys. Here. That's where we also have a lot of liquidity, because that's the low of the day. That's always where a lot of liquidity is. So let's fast forward. Guys, this will become so obvious to you guys, you cannot unsee it anymore after this video. You cannot unsee it after this video. What happened here? The market, big market participants, most likely, got rid of their 1,000 contracts. Somewhere maybe here or down here for a nice profit, a very nice profit, guys. A very nice profit. Probably hundreds of thousands, if not even millions of dollars in, what is that? 230 to 250, 20 minutes. That's why trading is the best business model in the world, because you can make no income claims whatsoever. You can make millions of dollars in a matter of a few short minutes. If you are a big hedge fund, big institution, or big bank, doesn't really matter. And you as a small participant in the market, as a retail trader, once you understand this logic, you can also take advantage. You can also profit from these tiny moves in the market. And they become very obvious to you guys, because you will soon understand the entire logic. Okay? So right here, we see the exact same that happened up here. Okay, so these big market participants might now once more go ahead, and they will most likely buy 1,000 contracts here. They will buy them, and at some point they need to get rid of them, right? So right now, where can they get rid of these contracts? Well, most likely either at the volume point of control of today, maybe at this level, or even this level. I don't know. But what we also need to know is, hey, we have some further liquidity down here. So this will most likely just be a small move, because we have a bunch of liquidity down here, most likely, a bunch of liquidity. So they will scalp this to somewhere where they can exit their 1,000 contracts. Let's see. Right here. This is if we take a look at today's range. Somewhere here, look at this. This is nearly the middle of the range, which is, just so you guys know, it's a little side note, an important area most likely. So the middle of this range is where the price is fair. Okay, so if we take a look at today's range, anything below this 50% mark here is at a discount, and anything above is at a premium. So you want to buy at a discount and sell at a fair value or at a premium. Okay, so the market might go up a tiny bit further, it might not, we don't know, but at some point we'll most likely go back here, because we still have a lot of liquidity here, because it's still the high of the day, and we will most likely go here. We know these two levels are still very interesting to us. Ooh, okay. We can delete this. Guys, what do we see again? A huge wick. We stopped exactly at our level of liquidity. This doesn't always happen, guys. Just so you know, sometimes the market goes down even further, fishes even more stops, and then gets back up into this range. However, when you see this, now it should become very obvious where the market is going to go next. Guys, same scenario. It's always the same scenario. Big market participants now bought, to stick with the example, 1,000 contracts somewhere down here. They bought them here. Where can they now get rid of those 1,000 contracts? Where? At today's volume point of control. So they might get rid of 500 contracts there, but also at today's high of the day, where there's still a lot of liquidity. Okay, guys, so let's check. We went in here once more, so they probably built up their position even further. Maybe they bought another 1,000 contracts. And you can even see this in the volume profile. You see how many contracts were being traded here? Quite a few. Interesting. For now, we don't trade because we are not at our level of interest yet. But what do we see now? Same story over and over and over again. So these 2,000 contracts were most likely being sold either here or somewhere here. So you as a retail trader, once you see this, once you understand this, you can get in here and you can sell here. You can sell here. You can go short here once more, and you just wait for what the market gives you right now. So if we take a look at the entire situation right now, what do we see? Let's take a look at the volume profile. I'm going to clean this up a little bit for you guys, and you will never unsee this once more. This volume profile right here is not normal, to be fair. This will look very different very soon, most likely. However, if we have a normal day, this will be a D volume profile. You also have a P volume profile. That's another shape. You can also have a capital B volume profile shape, and you can also have a small b volume profile shape. However, this right now, if we take a look at how a D looks like, capital D, then this looks like a D volume profile shape. And that indicates to us that today is a balanced day. Balanced days mean we go short here and we go long here. That's where our advantage is. We go long or short in low volume areas, and we try to stay away from high volume areas in terms of our entries. So right now, I probably wouldn't trade. Okay. The only thing that looks very interesting to me is this right here. This is an abnormality to the market. So usually a D volume profile, if you take a look at this, and I will show you guys some previous days. At the high of the day and at the low of the day, the volume should be low. So you should see a low volume node here and here. Right now though, we can see that we have, and this will become very obvious once more, a high volume node here. And a high volume node at the high of the day is an abnormality. And the market doesn't like abnormalities. It's not normal. So most likely the market will transact a bit further, maybe even break out here. But for sure, the market will take out this high and form, at least for now, a pretty nice volume profile. So knowing that, interesting. What am I looking for? I'm looking for a break of the high of the day and then go in short once more, most likely. Let's take a look. We don't trade here. We do not have an advantage. So yes, these are 5-minute candles. You set an alarm here and there. And once the alarm goes off, that's when you open up your laptop. That's when you open up your phone. And that's when you want to get active. Level of interest. Once more. We go back into this area. This is another setup, to be fair, guys. This is not the most obvious setup. However, once we break that low with high volume, meaning there was an absorption, I will tell you guys what an absorption is in just a second. Then we go back into this high volume area. Then you can trade this potentially to the middle of this area, or there's an 80% chance that we trade through the entire area at some point, just so you guys know. And there it is. About middle of this area, and now we turn around. Now guys, I told you about an absorption. What is an absorption? Put very simply, the market is structured in a way where you have the bids and the offers. Okay, so if you take a look at Bookmap, which is one of my favorite tools, you can see that we have large orders and smaller orders. Okay, and I will explain this to you guys. So right here, what can you see? You can see that we have smaller bubbles, aggressive selling. Red bubbles, aggressive selling. Green bubbles, aggressive buying. Okay, you can see that small red bubbles already push the market lower. That's normal price action. Okay, normal supply and demand. If 100 people want to buy an apple from a market, the same apple or the same car, think of it like an auction. You have an auction for a car, a BMW 3 Series. And then it starts off at 30,000 and a bunch of people want to buy it. What happens? Well, the price goes from 30 to 31, 32, 34, 35, all the way to 40, 45. As long as people want to buy, the price keeps going up. This is what happens here, just in the other way around, just in the short direction. But here, we have a bunch of sellers, a bunch of people who sold here. Yet the market didn't go down. That's an absorption. We have a passive buyer who is invisible at first. He buys up all of these contracts that are being sold down here, and he sets a stop to the market, and then the market turns around. In this case, at least for a short while. However, if we see this, and you can see this in the volume profile because there's usually a lot of volumes that are being traded at those absorption levels, then you can see, hey, level of interest, amazing. Absorption, perfect. Boop, get in, put a buy order here, sell somewhere at the high volume range somewhere here, and that's a nice profile. That's a nice trade. If you go in here, that's 64.01. You can get out at the 64.20, for example, 19 ticks, one contract, $190, 10 contracts, almost $2,000 in about 10 minutes. Beautiful, guys, beautiful. Okay, still, what do we see? We still have a D volume profile. Now it's shaped a little bit better because we actually took out the high of the day. However, where do we have a bunch of liquidity now? Here and also here. We have a D volume profile, so we still want to go short at the high of the day and long at the low of the day. Another short entry here. Now this, you need to get a very good entry here and then sell somewhere here most likely. But for now, you can see you would actually still be in your position. So if you went short here, you wouldn't have gotten out yet. You would have gotten out here right now. However, this was another entry. And just like that, put very simply, you now understand why the market moves the way it does. You combine the volume profile with knowledge of liquidity and a knowledge of and an understanding of what do these candles actually tell me. Okay. And if you guys ever thought about why is the market not breaking out? I'm going to explain this to you. This will become super obvious to you guys. Why is the market trading in a range like this right now? And why is it not breaking out to the upside? What is missing? And if you go for a breakout trade here, why are you always getting stopped out somewhere here? Why? What is happening? Well, think of it as fuel to the fire. If you are driving a car and you want to go for 300 miles, what do you need? Well, you need gas, right? So if you have enough gas, you can go for 300 miles. If you have too little gas, you can only go for 150 miles. Okay, so think of that exact situation right here. This, you go in here for a long trade. The market doesn't have a lot of gas right now. So right here is your 150 mile mark. Okay, this is 0. This is where you start off, obviously. And somewhere here, that's where 300 miles is. Okay, you now have fuel here for 150 miles. That's your fuel. Now, what do we need in order to go for 300 miles? We need more fuel to the fire. And where can we get that? What is fuel to the fire in the markets? It's liquidity. So what do we have? We talked about this, guys. We have liquidity here, but also there. So what you see happens all the time is the market breaks down. It breaks this low. It manipulates these low. We fish all of these stops. A big market participant buys, to stick with the example, 1,000 contracts right here. And where can they sell it? Well, potentially somewhere up here, right? Where there's a lot of buy liquidity. So they bought it here. They now need someone to sell these contracts to. And where are these people? They are right here. And that's when a breakout actually occurs because we now have fuel to the fire. So right now, if we take a look at this current day, we need more fuel to the fire to either break this high or to break this low. So you might see that one side is being manipulated. You believe, hey, a breakout is about to happen, but actually the opposite is true. That is a false breakout, and then you will see the market go lower, 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 or the other way around, obviously, and then you actually have your real breakout. Interesting. So that is how the market works. And once you understand this, because you now understand the logic behind the market, reading the market, trading the market, hopefully making some profits, can become a lot more achievable. No guarantees, like I said, obviously. I'm not making any income claims. I'm just telling you what works, but I don't want you to trust me. Think of it. No. Go into the charts, test me, and you will see this work over and over again. Pre 9:30, but also after 9:30. Let's take a look very quickly at yesterday's market. Okay, you go in at 9:30. That's when you start your trading day. It can also be 3 p.m. It doesn't really matter. But let's go in at 9:30. The market is open. Let's take a look at these charts very quickly, because a market analysis can be done in a couple of minutes. Where is liquidity? Guys, very easy. Here we have a lot of liquidity. Here we have a lot of liquidity. Here we do have a lot of liquidity, most likely, in this range. But also, obviously, a bunch of liquidity right here. What does the volume profile look like? It looks like a capital. It looks like a P, I'm sorry. So it's a P volume profile, a bullish volume profile. So we do expect that the market either grabs this level of liquidity or this level of liquidity and then transacts higher. That's basically what we expect. However, that's pre-market. Let's see what actually happens during the market open. The market pushes higher. You cannot expect this, to be fair. That was just a big push. The volume profile would have indicated, hey, a bullish move. However, this was just a huge move. Where does the market stop potentially? Let's check. The market stopped here. Why? Why does the market stop at the, what is it? I'm going to mark this for you guys. Why did the market stop here? Someone most likely, just so you guys know, bought a bunch of contracts down here. Up here, they bought them all. They bought them all. So they need a price level where they can sell those contracts to someone. So let's take a look. That most likely will be somewhere a high volume node of a previous day. Let's take a look. What is at that price level? Boop, a high volume node. Boop, a high volume node. Somewhere here in this range, you can see a lot of high volume. Previous price acceptance. People like to transact at previous high volume nodes because price was being accepted at these areas, so they can get rid of their contracts exactly at those levels. Interesting. Another rejection right here. Another rejection. You can see the candle, right? Guys, the market right now cannot go higher. Why? Because we don't have enough fuel to the fire right now. The market right now cannot go higher. It needs more liquidity. All right. And where can we get liquidity, guys? Potentially here. Well, maybe. Potentially down here. Yesterday's volume point of control. What is yesterday's volume point of control, guys? What is that? That is the previous level of price acceptance. We reject off of that level perfectly. We form a hammer stick candle. We probably got a lot of contracts down here. They probably bought thousands of contracts down here. Where can they sell them? Where can they sell these contracts now? Where? Where is liquidity, guys? Buy liquidity. Where is it? It's somewhere here, but it's also up here, right? Okay, let's take a look. The market participants went here, but they started taking out this liquidity once more. They are adding to their position. That can happen. So this would have been a trade where you might have gotten out for a small profit or potentially even a loss. Okay, but the same scenario is still valid. You go long here. You go long. Very interesting. You go long. All you want to do is go long. The market is just now moving higher and higher and higher. Look at this, guys. Where is the market most likely going to go next to? To the next level of liquidity. And if we take a look at this, how does it look like? It looks like a D volume profile once more, right? Ah, beautiful. So let's see what happens. Guys, do I need to say anything else? Look, take a look at this candle. Do I need to say anything else? Or is it becoming obvious to you guys? Is it becoming obvious to you guys what is happening in the markets? How the markets work? Is it becoming obvious to you guys? It should. And what else do we say? Where do we trade? Where do we not trade? We do not trade in high volume areas. We do not. So where do we trade? We trade in low volume areas. Somewhere here. Where's liquidity now? Well, liquidity is most likely here. And liquidity is still most likely somewhere up here, probably a bit higher. Okay, but we have a pretty balanced day so far. So what are we trading now? We are still trading short all the way up here. We're trading short. If you take a look at this intraday, this now looks a bit more bullish, to be completely fair. So get in here and get out as soon as you can. Meaning this is a more of a higher risk trade because the trend is clearly bullish and we had a huge rejection candle down here. So I am bullish on this, to be fair, overall. So this is a higher risk trade. Get in and out quickly. Don't expect these huge moves right now. Okay. And then at some point, maybe you're out of your position already because you should be by now. What is happening here? Whoa, 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 whoa. Guys, what is happening here? Look at the volume profile. Look at the volume profile. Was that the situation already? I believe so. High volume node. The market now comes down. And look at this, guys. This high volume node. It was built here. What happened here that the market couldn't go any lower, for now at least? What happened? And let's see. Because the market will most likely do something very, very special very soon. And I will tell you exactly what it does. It will break out. Why? Guys, the market, this is obviously not a breakout candle, by the way, obviously. The market formed an absorption up here. Would I trade this? Maybe. Low risk only. But what is an absorption? Well, think of the market going lower. Okay? The market is going lower, and we have this exact same situation here. The market is going lower. But then at this level here, at this price level, something happens. The market went lower with these small bubbles here. These are aggressive sellers. These green bubbles are aggressive buyers. And you can see the market didn't need a lot of selling to get down, right? To go lower in price. However, now you see this. You see this huge bubble right here. However, the market didn't go any further down. What happened? Right here, there was a passive buyer who said, hey, I'm willing to buy all of your contracts down here. He stepped in passively and bought all of these aggressive sellers down here. He held up the market. The market said, there's someone buying so much. I don't want to buy anymore. I don't want to sell anymore. That's it. That's all I have. And then the market took a breather, meaning there wasn't a lot of any more contracts being traded. The market took a breath. It rested. And usually that's exactly what you see here. And that's what this volume profile indicates. A lot of volume being traded, a lot of contracts being transacted here. So if you see this level, upward trend, huge rejection down here, absorption forming down here in this range, probably even some stops being fished, because guys, this is exactly what I explained to you previously. Remember this example? Our range. The market couldn't go any higher. We couldn't break this high. So what do we need? We need more fuel to the fire. Where do we get this? Below this range, right? Guys, boop, below the range. And now you can expect a market move up. Maybe for a small way, maybe for a big trade, doesn't really matter. Look at the timing of the day as well. It's already in the afternoon. This is lunchtime, so you cannot expect a huge move. However, this would have been a nice breakout. I told you guys, don't get in on this candle because this is a bearish candle. However, once you see this more bullish candle with a couple other things potentially here in the order flow, that's when you get in. Guys, do you see the market now in a different way? I hope so, because that is how the market functions. That is how the market moves from A to B. That's the logic behind it. That's how you understand how the market works. And once you understand how the market works, you can trade it, hopefully, a lot better now in the future. If you have any questions about this, because I know that was a lot of information, let me know in the comments down below. I hope you like this video. Leave a like, subscribe to this channel, and I'll see you guys either in the next live trading, in the next tutorial, or nonetheless in the next YouTube video. Until then, I wish you a great day and some good profits. I'll see you.